Welcome back to my channel. Today, we're embarking on an exciting journey into the realm of finance, where we'll be comparing two of the cornerstone assets in any investor's toolkit, stocks and bonds. These two financial instruments operate at opposite ends of the risk-return spectrum and play distinct roles in shaping investment portfolios. In this video, we'll take a deep dive into the key differences between stocks and bonds, shedding light on their unique characteristics to help you navigate the complex landscape of financial markets with confidence. 1. Ownership versus debt. Stocks, also known as equities, represent ownership stakes in a company. When you purchase shares of a company's stock, you're essentially buying a piece of that business. As a shareholder, you become a fractional owner, entitled to a proportionate share of the company's assets, earnings, and future growth prospects. Moreover, shareholders often enjoy voting rights, granting them a voice in corporate decisions ranging from electing the board of directors to approving major strategic initiatives. This ownership structure aligns the interests of shareholders with the long-term success of the company, fostering a sense of ownership and accountability among investors. Conversely, bonds are debt securities issued by corporations, governments, or municipalities to raise capital. When you invest in bonds, you're essentially acting as a lender, providing funds to the issuer in exchange for a promise of repayment with interest over a specified period. Unlike stocks, which confer ownership rights, bonds represent a contractual obligation on the part of the issuer to repay the principal amount borrowed, along with periodic interest payments. Bondholders do not possess ownership stakes in the issuing entity and typically lack voting privileges in corporate matters. Instead, they rely on the issuer's creditworthiness and ability to honor its debt obligations to generate returns on their investment. In essence, stocks offer investors a stake in the ownership and future prosperity of a company, while bonds represent a contractual claim on debt repayment from the issuer. Before we go to our second difference, remember to like the video and subscribe to the channel. 2. Risk and return. Stocks are renowned for their potential to deliver substantial returns over the long term, but this potential reward comes hand in hand with heightened volatility and uncertainty. As owners of a company's equity, shareholders are exposed to the inherent risks of the stock market, where prices can fluctuate wildly in response to economic indicators, market sentiment, and company-specific news. While stocks have historically outperformed bonds and other asset classes over extended periods, they are subject to significant price fluctuations and the possibility of loss, particularly in the short term. Investors must be prepared to weather market downturns and exercise patience to reap the rewards of long-term equity ownership. On the flip side, bonds are prized for their relative stability and income-generating potential. As fixed-income securities, bonds offer investors a predictable stream of interest income over the life of the bond, providing a source of cash flow and capital preservation in uncertain market conditions. Moreover, bonds are considered less volatile than stocks and are often perceived as safer investments, thanks to their priority claim on the issuer's assets in the event of bankruptcy. While bonds may offer lower returns compared to stocks, particularly in periods of economic expansion, they serve as a crucial component of diversified investment portfolios, offering stability, income, and downside protection during market downturns. In summary, stocks are characterized by their potential for high returns and greater volatility, while bonds offer stability, income, and a lower risk profile. 3. Income generation. Stocks, while offering the potential for capital appreciation, generally do not provide a consistent stream of income in the form of dividends. Dividends are periodic payments made by companies to their shareholders as a share of the company's profits. While some established companies with a history of profitability may offer regular dividend payments, many growth-oriented companies reinvest their earnings back into the business to fuel expansion and innovation. As a result, dividend income from stocks can vary widely and is not guaranteed, making stocks less reliable as an income-generating asset class. Conversely, bonds are renowned for their ability to generate a steady stream of income through regular interest payments. When you invest in bonds, you receive fixed or floating interest payments at predetermined intervals, typically semi-annually or annually, until the bond reaches maturity. This predictable income stream makes bonds an attractive option for investors seeking stable cash flow to meet living expenses, fund retirement, or diversify their investment income. Moreover, bondholders have a contractual claim on interest payments, providing a level of certainty and reliability that is often lacking in dividend income from stocks. In summary, while stocks offer the potential for capital appreciation, they generally do not provide a consistent stream of income, whereas bonds offer a reliable source of income through regular interest payments. 4. Priority of payments. In the unfortunate event that a company or government issuer experiences financial distress and is unable to meet its financial obligations, the priority of payments determines the order in which creditors are repaid. Stockholders, as owners of the company, are the last in line to receive payment in the event of bankruptcy or liquidation. In such scenarios, bondholders and other creditors with higher priority claims, such as secured lenders and bondholders, are entitled to receive repayment of their principal and accrued interest before any residual value is distributed to stockholders. As a result, stockholders bear the highest risk of loss in the event of issuer default, as they have the least protection against financial insolvency. In contrast, bondholders hold a senior claim on the issuer's assets and cash flows, placing them higher in the creditor hierarchy compared to stockholders. In the event of issuer default, bondholders have a legal right to receive repayment of their principal and accrued interest before any distributions are made to stockholders or other equity holders. This priority of payments provides bondholders with a measure of downside protection and reduces their exposure to credit risk, making bonds a relatively safer investment compared to stocks, particularly in times of economic uncertainty. In summary, while stockholders are the residual owners of a company and bear the highest risk of loss in the event of default, bondholders hold a senior claim on the issuer's assets and cash flows, providing them with greater protection against financial insolvency. The distinctions between stocks and bonds extend beyond their basic characteristics, encompassing income generation, priority of payments, and risk profiles. As investors, it's crucial to understand these differences and consider them when constructing a well-diversified investment portfolio. Whether you prioritize growth, income, or capital preservation, incorporating a mix of stocks and bonds tailored to your financial goals and risk tolerance can help you achieve long-term investment success. If you found this video insightful, don't forget to give it a thumbs up and subscribe to our channel for more educational content on investing and personal finance. Thanks for watching.